Shenzhen. Looking at the counter, I break past the 62.50 renminbi, heading towards 68 and followed by 75. Downside, the support is at 57. Okay, and then on we go to the S&P 500. S&P 500 have a correction for the last few days, and I think in the US market, today we are waiting for Friday, which is a debut, the first day trading of the SpaceX shares, which is priced at 135. And so for FKRI, we remain bearish buyers with our resistance at 1745. I can see that FKRI is testing at the 200 days moving average right now. But based on the technical setup, we think that downside it's possible to correct towards 1650 and followed by 1600. For FPO, we do see that the corrections remains in play. Right now the resistance is at 4840, and now this week we did a webinar on the Wednesday, and in the Wednesday I shared with the audience on three sectors. Firstly, it's actually a tech sector. I think that the tech sector there's still potentials to resume on the upside. And indeed, yesterday we do see that the Coraza have went very strong bullish price actions, break past 1 ringgit, heading towards 1 ringgit and 08. So in the event that there is a strong corrections, next support level that I'll be looking at is somewhere 82 cents and 76 cents. Then on apart from that, I do see also Guangchong have resumed on the upside movement yesterday by printing a fresh bullish candlestick. Hence, if Guangchong break past 1 ringgit and 5 cents, it should analysts still have a buy call on a Guangchong. Then on another sector that I'll be looking at during this June-July period will be the bank stocks. So one of the bank stocks that I'll be looking at in my watch list is actually Public Bank. Now it's actually doing a sideways consolidations, but at this price level, Public Bank still offer a 6% dividend yield for FY26. Then on, before I forget, some of the banks are giving dividends in the month of August. So apart from Public Bank, we can actually look at other banks as well. Then on in trading stocks, firstly we look at Petronas Chemical, break past 5 ringgit 70 cents, heading towards 6 ringgit 10 cents and followed by 6 ringgit 50 cents. Downside support is 5 ringgit and 30 cents. Secondly, we have Northeast Group that jump above 98 cents on the back of high volume. So next R1 will be 1 ringgit 5 cents and followed by 1 ringgit and 12 cents. Downside support is 91 cents. So we have one oil and gas counter, Petronas Chemical, and then one tech stock, which is the Northeast Group breakout stocks. So I'll stop here and pass the stage to Leng of the organization report. Thank you.
Thank you, Joseph. So today we've got an initiation report for you. This is Seng Plantations, and it's basically a good proxy to the current stable and high CPO prices, and it's pretty undervalued as well. So maybe just let me run through the background of or rather the investment thesis of Seng Plantations. So just quickly first though, Seng Plantations basically is a pure Sabah-based planter, and in terms of land bank size, their land bank size is slightly smaller, I guess, compared to some of the big boys out there. Their land bank size is around about sorry, hang on a second. Is about almost 40,000 hectares in Sabah purely, and is spread across 5 estates. It has 4 milling operations, and combined mill capacity is 180 tons per hour. So a pure planter with no downstream operations. So just running through the investment thesis, basically in terms of Seng Plantations dividend. They have a pretty good dividend policy of at least 60%. And basically only in the years of 2022 and 2025, they paid out slightly lower than that. So the yields have been pretty decent, between 3 to 8%. And this is at the higher end of its peers. If you look at the peer average, it's only at around about 3 to 4%. Furthermore, they are sitting on a net cash pile of about 646 million ringgit, or 81 cents per share, as at FY 2025. And they don't have any major capex requirements, so we don't think that they should have any restrictions to maximize shareholders' return. So we are looking at a dividend yield of about 5 to 6% for FY 26 to 27. Of course, being a pure planter, they are definitely a prime beneficiary of the higher CPO prices, and we have seen, as you know, CPO prices rising by about 15% in the 8 weeks since the Middle East conflict. Year-to-date price is around about 4,300 ringgit per ton. So we estimate that as a pure planter, you know, they are every 10%, every 100 ringgit change in CPO price would increase their earnings by around about 8 to 10%. So definitely, you know, you would be able to see them benefit as CPO prices increase. We note that if you look at share price movement, however, you know, Hap Seng Plantation, of course, while CPO prices move up, Hap Seng Plantation prices also share price also moves up. But when CPO prices come down, Hap Seng Plantation's share price does not decrease as much. So if you look at 2025, you know, when CPO prices fell by about 22%, Hap Seng Plant share price only fell by around about 5%, which shows that the stock is pretty resilient, even in a lower CPO price environment. So our CPO price assumption for this year, as mentioned, is about 4,004 average for the year. If you look at their CPO prices that they have managed to achieve as well, they managed to achieve historically higher ASPs versus the MPOB average. And that is because they are 100% RSPO as well as MSPO certified. And so if you look at their price ASP realized versus MPOB, generally is about 5% higher. Particularly in 2024, it was the highest at about 5%. You know, but generally it's around about 3 to 4%, and then that's basically what we are expecting. In terms of FFB outlook, you know, if you look at the last few years, FFB output has been relatively, you know, uncertain, where you see some years up, some years down. But I think this year, 2026, we have seen up to the 4 months period, FFB output has shown a very good improvement of 11.4% increase year on year versus last year, where they actually saw a minus 5.5% drop. And so this year is the year of recovery for them in terms of the FFB output. Management is expecting FFB growth of about 16% for this year. You know, but we are being a bit more conservative, where we are putting in imputing a 10% FFB growth for this year. And then for the next few years, we will be looking at about 5 to 6% growth in terms of FFB. If you look at you know, the age profile, basically age profile of Hap Seng's trees slightly older, I guess, than the peers, where the average age is around about 17.3 years, with about 35% in the prime mature age. 46% in the prime mature age, and you know, more than 17 years is around about 11%. So basically, they are trying to replant a little bit more this year, where they're going to replant about 1,000 hectares this year, you know, versus I think in previous years less than 1,000 hectares per year. If you look at even if you look at the yields and the oil extraction rates, their yields and oil extraction rates are consistently higher than the Malaysian and Sabah average, and we expect this to continue as long as they maintain their replanting strategies. So overall, in terms of valuations, we believe that Hap Seng plant should we are pegging Seng Plant's target price to be at a PE of 12 times FY 2026 PE, and that gives you a target price of 2 ringgit 60 cents. And 12 times is basically the 5-year historical mean. We do note that the stock has traded at +1 standard deviation before in 2023 to 2024. And that's basically your upside there. So we are pegging it right now at its 5-year historical mean, but it has traded at above that before. We put it at a slight discount to JPG, where we peg a 15 times PE, and that's mainly because JPG's age profile is more is younger, and therefore and they are also moving towards doing downstream, and their downstream is expected to give them pretty decent, really good margins, and so we have pegged them at a higher PE. But for Seng Plant, basically, the mid cap planters, we normally peg it at around about 8 to 12 times. So pegging Seng Plant at 12 times is at the higher end of its mid cap peer range, which we believe is deserved, because a lot of the mid cap peers are the Sarawak based planters, which we believe will normally trade at a discount, given that most of it is on peat soil. So basically, we are initiating coverage on Seng Plant with a buy, with a target price of 260. Our target price has also increased, imputed their ESG score, which is 3.2. So we've given them a 4% premium for ESG. So earnings is expected to grow at a 5-year CAGR of 13%, and that's underpinned by the higher CPO prices as well as a healthy FFB recovery outlook, and that should also reduce unit costs. So we'll stop here and pass on to Alex. Thank you very much.
Hi, morning all. Thanks for dialing in to Morning Cup at 8. Essentially, just let me run through our report this morning that focuses on the Malaysia Value Up program. This is an initiative that was initially mooted jointly by the Securities Commission and Bursa Malaysia in conjunction with the launch of the Capital Markets Master Plan 2026-2030 back in April. And this was followed up by the publication this week of the Value Up Guidebook. So essentially, Value Up initiative is aimed at unlocking and improving long-term valuations for public listed companies, improving shareholder value creation. It aims to force a paradigm shift by moving public listed companies towards doing the things that improve in terms of business strategy, plans, governance, and also the communication of those plans to stakeholders and the market. This includes strategic assessments, enhanced governance, efficient resource allocation, and the effective communication of all those plans that is supposed to act as catalyst to narrow the any structural valuation discounts suffered by certain companies. So I think essentially what we think is that these initiatives involve activity that most public listed companies would already be doing. But we think that this is obviously a positive step towards enhancing market quality and spelling out these plans and initiatives for the PLCs to follow is obviously a good thing. And SC and the Securities Commission and Bursa already point to similar value up initiatives that have created positive valuation enhancements in regional markets of Japan, Korea, and Taiwan in recent years. But I think if you look at the governance and other market outreach programs already done by the big caps, the KLCI companies, most, if not all, every single big cap company listed is already doing these initiatives. So essentially, we feel that this value up program will, I think, serve to benefit the mid cap names, and therefore the mid cap companies are the ones that stand to benefit if they polish up their value up initiatives and properly communicate their plans to the public, to the investment public. And therefore, we think that going forward, the Bursa Malaysia already trades at a valuation premium to our regional peers, and therefore, from the large cap perspective, the gains that can be eked out, the valuation gains that can be eked out from value up program is probably somewhat going to be modest. But I think from the mid cap names onwards, the mid caps and the smaller cap names obviously have more ground to make up from that perspective. So take a look at the report, and I think you'll find a lot of the things in there fairly self-explanatory. But we feel that this is a good and positive step by the regulators, that will move the markets to the next level and help to further enhance quality, to help buffer confidence, improve sentiment, and drive sustainable capital inflows. Okay, that's it from me. Thanks for dialing in. Have a great day ahead and a lovely weekend. Thanks, everyone. Cheers.